I wanted to share some fair value gap secrets on gold. I'm going to go ahead and put the camera on. You can go ahead and skip this because I'm going to have to go ahead and it's going to take like 1 second. Let's go here, view. Alrighty guys, so sorry about the hair, dude. It's fucking been a long weekend. Yeah, let's just go ahead and let's get right into what I want to get into. So, fair value gap secrets on gold. So the first thing I want to go over with you guys is this. Here is some of the things that I do. So on my screen right now, if it fucking pops up, holy shit. Yeah, go ahead and skip this. Go ahead and skip to the part of the video where it starts, because this is just a float on top. I need to find that fucking thing. Hold on. Alright, sorry about that. Okay, so fair value gap secrets. So the reason you're looking at the gold chart right now and you see all of these different words labeled to these different zones is because I actually have a method that I use to spot and help me identify where the direction of gold is going to. So when I'm on gold, I go to the weekly chart, then I look at the demand zones and I look at the gaps on the weekly chart, and then after I do that, I go on a daily chart. And when I'm doing that, it allows me to see the candle that is in supply. So supply and demand, essentially. So right now, as you can see, the gray candle, this big giant bearish candle, is disrupting the flow of the previous trend, or the trend that was going on here. And that is because there is a lot of volume in the market due to the Trump's tariffs and all the stuff that's been happening in the market, and that's causing the markets to move, especially with gold. When you go to the smaller time frames, you can actually see the shift in markets when you're trading in the market when you're trading gold. So right now I'm on the 4-hour, and you can see on the 4-hour that there is a obvious momentum shift, and I'll even point it out here. So right now, okay, you see the trend. It was bullish up. We had higher highs, higher low. We had a low here, then we had expansion, and after this expansion, the market, I thought, was going to come back to this order block, which is right there, and or this gap on this fair value gap on a small time frame too, and reverse from here, because this looks like the demand, right? And it didn't. It came down, broke this demand, and after it broke this demand, something interesting happened, guys, and I want to show you. So where it broke, the demand was the low, because the low of the demand, right? So this is the low point, the black line that I'm drawing. And price, the gray candle, broke that black line. And what did it do after it broke that black line, which represents the demand and the low of that being broken? It came back up. Look at the blue candle. It came back up and it tapped into this fair value gap up top here, where you see all of this. Sorry guys, I know the chart's kind of messy, but it tapped into this gap where you're looking at right here. This is the gap it tapped into. Okay, it tapped into that gap, and it reversed, and we had a second tap. It tapped into that gap after breaking structure to retrace, because that's what the markets do. The markets just doesn't go straight down. The markets go down, up, or up, down, and that represents the retracement to mitigate the positions, also to balance out the market. So when markets go down, you're basically entering off the pullbacks, and I say in every video. Right here in this case, you could have entered off this pullback, but I'm just explaining the shift in the market in itself, which was price breaking this demand at the black line and then coming to retrace to that gap, and after it retraced to that gap, price dropped again, and it tapped into the gap again, dropped again. And so this is where the market shift happened, and this is an example of why using the 4-hour time frame in the higher time frames of trading gold is important, because it shows you an obvious shift. So when you go on a smaller time frames, like look, the 15-minute, you can still see the shift, but it isn't as obvious, because when the higher time frames that you go, sorry, the wind, I had the fucking door open. The higher time frames that you guys go on, the bigger and more obvious price action gets. You ever notice that? The bigger the candles are. So if I go to the 4 hour, the candles are going to be bigger, and it shows you obviously the disruption of the trend. So it's like a cheat code. And then the secret is to not actually enter on the gap on the 4 hour or daily or blah blah in itself. You can see, here's the secret that helped me trade gold. Identify, let's say you found a 4 hour, 15-minute fair value gap right here that you wanted to trade. What you would do is, right here. You see where the blue arrow is pointed to? Imagine a gap right there, okay? And that's where you wanted to trade, that fair value gap. And imagine, you're like, okay, well, I want to enter there. You shouldn't enter there because you're on the 4 hour chart. So if you enter on a smaller time frame, if you enter on the 4 hour chart, that's going to mess up your risk to reward and cause you to have an outrageous stop loss. So what you do, instead of trade the actual gap itself, I wait for price to come to that level on a smaller time frame, and then I want to see a reaction happen on the smaller time frame that's obvious that I can enter off of, right? So if the gap that I chose was this one, this first gray box, that's the one on top that blue arrow is pointing to. If I chose this fair value gap to trade first here, I would wait, because it's on the this is the 4 hour gap. I would want to wait for price to come up to this gap, and I want to see maybe some consolidation, because the market usually does that before it expands heavily. It consolidates and expands. I don't trade the consolidations. I trade when there's volume in the market. When there's volume in the market will go from moving barely to expanding, to an expansion. So that's what I'm doing. So I'm waiting for the market to come here, my point of interest, POI, which stands for point of interest, and I want the market to come down and break and maybe disrupt the trend that came up to that gap itself. So by disrupt, I mean I won't want to wait and see a break of structure or change of character on the way down, and then when I see that, I can enter in on the retracement. And then that retracement can be a gap up here on the higher part of the range. So whenever price disrupts a trend or creates a break of structure or a change of character, you always want to identify that by drawing your high and low. So let's say this high and low that I'm drawing right now represents the new trend, because price was going up and we had an expansion, right, of unhealthy price action that caused a new trend. So what I'm gonna do is I'm gonna draw the low, mark up the low of that, and then mark up the high of that, and then trade that range. Not consolidation range, but the range of the high and low of price. So if you're selling, you want to sell high, and you're buying, you want to buy low. And that's pretty much all I have to say for this video. I'm going to make another one later, but I just wanted to share some tips, and yeah. So it's the main tips the point I wanted to make in this video was the fact that you need to utilize the 4 hour and the daily in the higher time frames to see the momentum shift of your trends, because when you do that, then you can enter on the 5 minute, for example, on the 15-minute and the 3 minute on gold, because I know gold moves slower, and I start on the 3 minute and the 5 minute because usually on the 1 hour price action doesn't really show differently. It's a little bit different. The 1 hour is like the 4 hour on gold, so I use the 5 minute and the 3 minute because it shows me more in depth of what's happening. And yeah, so that's what I do. And I hope if you have any more questions, leave a comment. And yeah, I'm going to make another video later. Peace.